$17 trillion. That is how much wealth American households lost during the Great Depression. Stocks fell nearly 90%. 10,000 banks failed. Unemployment reached 25%. An entire generation was financially erased. History calls it the worst economic collapse of the modern era. But here is the reality few are prepared to face in 2026. What lies ahead is not similar to that period. It is worse. Not emotionally worse, mathematically worse, structurally worse. Today, total debt in the American system stands at $98 trillion. That figure includes government, corporate, household, and financial sector debt combined. In 1929, total debt adjusted to today's dollars was roughly $290 billion. That means the system now carries more than 300 times the debt load that existed at the start of the Great Depression. But scale is only part of the danger. In 1929, financial failures were contained. A bank collapse in one state did not instantly destroy institutions across the country. Today, everything is interconnected. Digital markets, derivatives, global capital flows, and leverage have fused the system into a single structure. When one segment fails, stress transmits everywhere at once. Even more critical this time, the breakdown is not isolated. Stocks, bonds, real estate, and the currency itself are all under pressure simultaneously. There is no rotation, no safe harbor, no asset class immune to contagion. This is not a crisis forming in the distance. It is a crisis already in motion. Across history, every debt-driven collapse has followed the same four-stage sequence, no exceptions. In the chapters ahead, I will break down that pattern and show exactly where we are now. This is not opinion. It is arithmetic. And once you understand the mechanism, you will see why 2026 is not a warning. It is the moment the system reveals itself. Comment 1 to continue or 2 to stop here, and subscribe if you want to understand what comes next. To understand why the outcome is unavoidable, you need to understand the mechanism. Debt crises are not random events. They are not black swans. They do not depend on politics, personalities, or intentions. They follow a fixed mathematical sequence that has repeated throughout history with mechanical precision. 4 stages, always in the same order, always with the same ending. Stage 1 is the foundation. This is the phase every stable economy begins with. Growth is driven by productivity, innovation, real output, and sound money. Debt exists, but it plays a supporting role. Credit finances, farms, factories, infrastructure, and businesses that generate real returns. Income grows faster than liabilities. This is genuine wealth creation. The system earns its expansion. Stage 2 is expansion. Credit becomes easier, lending standards loosen. Debt begins to grow faster than the underlying economy. At first, this feels positive. Asset prices rise, stocks climb, real estate appreciates, people feel wealthier and borrow against those rising values. Banks lend more because collateral appears stronger. The feedback loop forms. Higher prices justify more debt, and more debt pushes prices higher. This phase becomes politically and economically addictive. Banks profit from loan growth. Investors profit from asset inflation. Governments collect more tax revenue from transactions and capital gains. Entire industries form around finance speculation and leverage. At this point, stopping credit expansion becomes impossible. The system itself now depends on debt growth to function. The danger is invisible during this phase because nothing appears broken. But the gap between what is owed and what can realistically be repaid keeps widening. Debt is no longer funding production. It is funding price inflation. The economy begins to consume its future growth to support the present illusion of prosperity. This is the most deceptive stage of the cycle. It convinces intelligent people that the system is healthy precisely when it is becoming fragile. And once expansion reaches its limit, the transition to the next stage is not gradual. It is abrupt. Stage 3 is where illusion collides with reality. This is the trigger phase, and it is the most misunderstood part of every debt crisis. People assume the collapse is caused by a single event, a policy mistake, a war, or a shock. That belief is wrong. The trigger is never the cause. It is merely the moment the system can no longer roll over its debt. At this stage, something small breaks the cycle of expansion. It can be a change in interest rates, a regulatory shift, a loss of confidence, or a foreign disturbance. The spark itself is irrelevant. What matters is timing. The weakest borrowers suddenly cannot refinance old debt with new debt. Defaults begin quietly, often in corners no one is watching. Because the system is heavily leveraged. Those small failures do not remain isolated. Asset prices stop rising. Then they flatten, then they fall. As prices fall, collateral values decline. When collateral shrinks, lenders pull back. Loans are not renewed. Credit lines are reduced. Borrowers are forced to sell assets to raise cash. This is where the feedback loop reverses. Forced selling pushes prices lower. Lower prices trigger margin calls. Margin calls force more selling. Liquidity evaporates. The same mechanism that amplified gains during expansion now amplifies losses during contraction. Greed is replaced by fear. Lending is replaced by hoarding. Trust disappears. Here is the critical insight most people miss. The debt does not vanish. Every dollar of debt is someone else's asset. When borrowers default, lenders absorb the loss. When lenders take losses, they cut credit. When credit contracts, the economy shrinks. Shrinking income leads to more defaults. The loop feeds itself. Once this phase begins, policy tools lose their power. Central banks can inject liquidity, but they cannot force lending. Governments can stimulate, but they cannot restore solvency. The system is no longer expanding. It is deleveraging. And deleveraging always accelerates. This stage feels chaotic, but it is not random. It is the inevitable result of too much debt built on inflated prices. And once the trigger phase is fully engaged, there is only one stage left. Stage 4 is the part history remembers, but only after it has already passed. This is the destruction phase when the system resets itself by force. Debts that cannot be repaid are eliminated either through default inflation or a combination of both. Asset prices collapse until they reflect real economic output rather than leveraged expectations. Wealth does not disappear evenly. It concentrates. Those holding paper claims tied to inflated values are wiped out. Stocks priced for perpetual growth bonds, priced for stability that never existed, and real estate bought with excessive leverage all reprice violently. The middle class, whose savings are concentrated in these assets, absorbs the majority of the damage. This is not punishment. It is mechanics. Cash flow dries up. Businesses fail. Unemployment surges. Governments face collapsing tax revenues just as social support demands explode. Social tension rises because economic pain always manifests politically. Trust in institutions erodes. People search for someone to blame, but the process itself is indifferent to narratives. At the same time, a transfer occurs. Those who held liquidity, real assets, or claims outside the inflated system gain relative power. They acquire assets at fractions of previous prices. This is how wealth consolidates after every major debt reset. Not through conspiracy, but through positioning. Eventually, after enough destruction, the system stabilizes. Debt levels fall. Prices normalize. Productivity slowly rebuilds. A new foundation forms and the cycle begins again because human behavior does not change. Confidence returns. Memory fades. Leverage reappears. Every major collapse in history has followed this exact four-stage structure. Foundation, expansion, trigger, destruction. Different centuries, different currencies, different technologies, identical outcomes. The names change, the math does not. Understanding this sequence is not about fear, it is about clarity. If you can identify the stage, you can understand what actions make sense and which ones are suicidal. And to see how precise this pattern really is, we now need to look backward at history and compare it point by point. The Great Depression is not a mystery. It is one of the most documented financial collapses in history, and it followed the four-stage pattern with exact precision. Stage 1 was the post-World War I foundation. The United States emerged as an industrial powerhouse. Productivity surged, manufacturing expanded, real economic growth supported rising incomes. That foundation was legitimate. Stage 2 arrived in the late 1920s. Credit exploded. Margin debt allowed investors to buy stocks with as little as 10% down. Asset prices disconnected from reality. From 1925 to 1929, stock prices tripled while earnings lagged behind. Price-to-earnings ratios climbed above historical norms. Speculation replaced investment. Florida real estate boomed. Get-rich-quick schemes flourished. Debt accumulated quietly beneath the surface. Stage 3 was triggered in October 1929. As stock prices slipped, brokers issued margin calls. Investors had no cash. They owned stocks purchased with borrowed money. To raise cash, they sold assets. Selling pushed prices lower, triggering more margin calls and more forced selling. Within days, panic spread. Liquidity vanished. The feedback loop turned vicious. Stage 4 lasted years. From peak to trough, the stock market fell nearly 90%. More than 9,000 banks failed. Depositors lost their savings. There was no insurance, no safety net. GDP collapsed. Official unemployment reached 25%, with real unemployment far higher. The social fabric tore under the strain. Breadlines formed, families lost homes and land, wealth concentrated as those with capital bought assets at pennies on the dollar. Every component of the four-stage cycle played out exactly as theory predicts. Nothing about it was accidental, and most importantly, nearly everyone believed it could not happen again until it did. This is why historical comparison matters. Not because circumstances repeat, but because behavior does. And once you recognize the structure, you can see the same pattern reappearing across different countries, currencies, and centuries. If the Great Depression feels distant, there are faster and even more brutal examples that remove any doubt. One of the clearest is Germany's collapse in the early 1920s. Before the crisis, Germany had a strong industrial base, advanced manufacturing, and a productive workforce. That was the foundation stage. The economy itself was not weak. Stage 2 began after World War I. Reparations imposed obligations far beyond what taxation could support. Rather than default, immediately the government chose monetary expansion. Money printing started slowly, then accelerated. At first, the damage seemed manageable. Wages rose, employment held, people assumed stability would return. That illusion is always strongest during expansion. Stage 3 arrived when confidence cracked. As monetary creation accelerated, the currency weakened. Foreign pressure and internal instability pushed the system past its limit. The exchange rate collapsed. Prices rose not gradually, but exponentially. What had been manageable inflation turned into a loss of trust in money itself. Stage 4 was total destruction. Savings denominated in the currency became worthless. Pensions evaporated. Middle-class wealth disappeared almost overnight. Those holding real assets, foreign currency, or hard stores of value survived. Everyone else was erased. The reset was swift and absolute. A new currency was introduced, and the old one became useless. The lesson from Germany is speed. When currency confidence breaks, the transition from stability to collapse can take months, not years. The same four stages appeared, but compressed in time. Debt that could not be serviced was eliminated through inflation rather than default. This example matters because it shows another path through stage 4. Collapse does not always arrive through falling prices alone. It can arrive through currency destruction. And once that process begins, policy responses lose control even faster. History does not warn gently. It repeats forcefully. And to understand the full scope of what is coming, we need one more modern example that unfolded in slow motion. Japan provides the modern blueprint for what happens when a debt bubble is sustained for too long. After World War II, Japan built a powerful foundation. Manufacturing exports and productivity drove real growth for decades. That was stage 1. The economy earned its expansion. Stage 2 took hold in the 1980s. Credit growth accelerated. Banks lent aggressively against rising real estate values. Asset prices went parabolic. Land in central Tokyo was valued higher than entire countries. The stock market tripled in a few years. Price-to-earnings ratios reached extremes. Debt expanded far faster than income. Confidence became absolute. Stage 3 was triggered in late 1989 when the central bank raised interest rates to cool speculation. That single shift broke the refinancing cycle. Stock prices peaked and collapsed. Real estate followed. Collateral values fell. Banks faced losses on loans backed by inflated assets. Lending froze. Forced selling began. Stage 4 unfolded over decades rather than years. Asset prices fell more than 70%. Banks failed or survived only through state support. Growth stagnated, wages flatlined. The economy entered a long period of paralysis, now known as the lost decades. Intervention delayed collapse, but it did not eliminate the debt overhang. The damage became permanent. Japan proves that even advanced economies with strong institutions cannot escape the debt cycle. It also reveals the cost of intervention. When collapse is delayed, recovery is weakened. The system survives, but prosperity does not. These three examples, America, Germany, Japan, span different cultures, currencies, and eras, yet each followed the same 4 stages. The differences are cosmetic. The mechanism is universal. And now with that context, we can map the pattern directly onto the United States today. Now we map the pattern to the United States in 2026. Stage 1 is complete. America's foundation was real. After World War II, the country emerged with industrial dominance, manufacturing capacity, trade surpluses, and a currency anchored to gold under the Bretton Woods system. Productivity drove growth. Debt existed, but it was restrained and supported by real output. That phase is unquestionable. Stage 2 began in 1971, the moment the gold window was closed. With that decision, all external limits on debt creation vanished. Credit market debt stood near $2 trillion at the time. Today, it stands at $98 trillion. That is not inflation. That is exponential leverage. Government debt exploded. Household debt multiplied. Corporate borrowing surged.